You said as recently as last week that while things are trending in the right direction, you would need to see further evidence before cutting rates. So here's my question, Mr. Chairman. What specifically are you looking at and looking for as we head into the next FOMC meeting, and how do you factor in this recent labor data, and certainly the significant part of that being government jobs?
So we're looking for two things, really. One is just more good inflation data. And we had quite a lot of good inflation data the last 7 months of last year. Then we had kind of a bump in inflation in the first quarter. And now we've had one good and one very good inflation reading, and we need more good data so that we can be confident that what we're seeing is really, that's where inflation's going, that it's going back down toward 2%. We don't need to see it at 2%. Right now we're at 2.6%. So that's on inflation. On the labor market, to your question, we've seen that the labor market has cooled really significantly across so many measures, and a number of people here today have pointed them out, and the unemployment rate has moved up. You see a labor market that is now pretty much in balance, pretty much where it was in 2019. It's not a source of broad inflationary pressures for the economy now, but it's still a strong labor market. 4.1% unemployment is a very good and historically low unemployment rate. So we have a mandate to support maximum employment, and we also are paying close attention. And if we see that the labor market were weakening unexpectedly, which is to say, more than what we've seen in a material way, unexpectedly, then we could also respond to that, because we have a dual mandate, and we now see the two mandates as more in balance than they were a year ago. Really, the focus had to be and was on inflation. Now we need to be focusing on both goals.